Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams and I'm going to get us started for today's session, How to Navigate New Cost Report Instructions and Exhibits. Before we begin, I'm going to play a brief video.
Welcome and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I'd like to introduce today's presenters, Jonathan Mason, Director at Moss Adams, and Heather Keser, Manager at Moss Adams. Their bios and contact information are located in your webcast console if you would like more information. And now I'd like to turn the floor over to Jonathan to get the presentation started. Jonathan?
All right. Well, thanks, Amy, and thank you for everyone joining us today. So let's take a quick look at the items we'll be discussing. First, we'll give a very brief recap of the current landscape in regards to the uncompensated care program and the most recent 2022 IPPS updates. Then Heather will then spend a good portion of our presentation covering the ongoing federal 2019 audit. We think this information is extremely useful as you plan accordingly regarding your future S10 reporting. We also think this information will be critical as a foundation for what we will be discussing when we cover the new proposed S10 instructions and required templates. There are massive changes from current reporting requirements, and I think as we go through some of the changes, you will see that a lot of the updates stem from what the MACs have experienced in these audits. We will also cover changes to Medicare DSH reporting requirements as well as Medicare Bad Debt, and hopefully we'll have some time to field any questions you might have. So let's go ahead and jump into it. I know that most on the call are very familiar with the UC calculation, but we always have a few in our presentations whose hospitals don't always participate in the UC program each year or are new participants. And we always like to quickly provide some background to the calculation methodology. As a result of the Affordable Care Act, the federal Medicare DSH payment calculation was bifurcated, with 25% of the computed amount going directly to hospitals under the historical DSH formula, and the remaining 75% is now established by a fixed UC pool shared by qualifying hospitals nationally. This federal UC pool is comprised of 3 factors: Factor 1 is the difference between an estimate of what would have been paid to qualifying hospitals under the historical DSH formula and the 25% empirically justified amount. Now, Factor 2 reduces the Factor 1 UC pool based on the change of the national uninsured rate, and ultimately this establishes the net UC pool to be distributed to the qualifying hospitals. And this brings us to Factor 3, which is how qualifying hospitals actually get their individual piece of the pie. So here's a view of Factor 1 from a trending standpoint since 2014. Factor 1 was increasing at an average of 4.6% through 2020 before falling dramatically in 2021, an 8.5% decrease. And now in 2022, a 7% decrease. So regarding Factor 2, the short story here is that for fiscal year 2022, CMS has elected to basically utilize a similar methodology to that employed since 2018. However, as with last year's rulemaking cycle, there were still questions regarding how the implications of the pandemic were factored into the uninsured rate that is being estimated for 2021 and 2022. So for calendar years 2021 and 2022, the estimated rate, or estimated uninsured rate, I should say, is 9.8% and 9.5%. The calendar year values are then converted to the payment year using a weighted average approach to get to 9.6%. So after running it through the formula, Factor 2 now equals 68.57% as compared to last year's final rule of 72.86. So that's a pretty big dip. And couple that with the drop in Factor 1 amount, hospitals are now splitting a significantly smaller pool amount. And so to get to the final UC pool calculation, you then apply that 68.57% uninsured rate to the 10.489 billion Factor 1 to derive an uncompensated care pool of $7.192 billion. And that will be distributed to 2,351 qualifying hospitals. So this represents a decrease of over $1 billion compared to last year's final rule totals. And so for the actual distribution of the pool, audited S10 data from the 2018 cost reports is being used, with a couple exceptions noted on the slide. And it was also noted that future UC calculations would use the most recent single year audited S10. And so now before we go into the latest audits, I did want to recap the last rulemaking session and the most recent comments from CMS about the audit process. I think this is a good starting point to understand some of the concerns of the provider community that will then give you a good frame of reference as we discuss the latest S10 audit findings, and that will then lead into our discussion regarding the proposed S10 cost report changes. The number one complaint or comment with S10 reporting and auditing from the provider community is they just want consistency. That's consistency in regards to how the audits are conducted, consistent or uniform templates for cost report submissions, consistency in regards to how certain scenarios should be treated in S10. Hospitals also want more time to respond to adverse audit determinations and also establish a consistent audit and appeal process, very similar to the wage index audits. So CMS responded to these comments, stating that they do provide the audit protocols in advance of the audit to ensure consistency and timeliness in the audit process. But they don't plan on introducing an audit process such as wage index, and as of now, do not intend to establish a fixed start date for audits across all MACs. So now most providers have been subject to audits for multiple years, with all qualified hospitals now in round 2 of audits since CMS expanded the number of audits to include all the hospitals eligible for Medicare DSH payments. So kind of with that backdrop, I'll now hand it over to Heather to walk us through these latest S10 audits.
All right, thank you, Jonathan. So as the federal 2019 audits begin, you can see here on this slide that items requested to begin the audits are standard letters request a copy of the financial systems policies, financial statements, working trial balances, as well as the bad debt reconciliations between the bad debt in line 26 and the financials. They're also requesting the detailed listings of transaction codes and descriptions and the detail that's behind lines 20, 22, and 26, as well as the detailed logic on how the facility prepared the S10s. There were also a few MACs that included what's called an S10 questionnaire, which included additional questions related to how the detail was prepared for the S10s. So moving on, let's just see here. My slide is out of order. So anyway, I will continue. So something I wanted to bring up to light is before the audits began, there's a number of things that auditors are testing these samples for, and one of those relate to reconciliation of accounts. On these detailed listings that we're providing, you can see that these templates are very difficult to complete, but the formula that the auditors are expecting to receive relate to the total charges, less payments and adjustments, and those should equal the charity write-off. And so you can see on account 1, this account reconciles to a variance of 0. And for account 2, you can see that the variance left on the account is positive. This could happen whereas the accounts may still hold an account balance that would result in a positive variance. Majority, if not most of those auditors accepted that the accounts can still have balances remaining on the accounts. But to go the other way, where accounts have negative balances, such as account 3, these could be related to accounts where they're written off to charity or bad debt during the fiscal year, but additional activity happens on these accounts in the future cost reporting period timeframe. So for example, an account happened to have, was given a self-paid discount for current fiscal year, but was later deemed to have an insurance. The insurance provided a payment, and then the self-paid discount would have been reversed on a future cost reporting period. But during the time frame of the cost reporting period, the account would have tied out just written off to charity. And another example for account 3 is if an account was written off to bad debt, but then later the patient came back and made a payment towards the bad debt amount, these would be identified as recoveries. Now, during the time frame of the cost reporting period, the account would have tied out just written off to bad debt. But at this time, after the data pool, after the fiscal year end, these patient payments would appear to make it look like there was too much written off to bad debt, therefore causing a negative balance. So to continue on and to explain some of these additional anomalies is that many times accounts can have multiple write-off dates. And in addition, they could span multiple cost reporting periods. So per the audit template request, each of these patient accounts recorded should be summarized. It states to roll each account up into one cohesive horizontal line of data. Vertical detail items like revenue code detail and multiple write-off dates should be reported as supplemental listings and relate back to the horizontal summary via the unique encounter number. So for an example here shown on this slide, we would expect to see $500 in charity written off for fiscal year 2018 for this particular account. And then for 2019, you can see there's an additional transaction related to $1,000. So in a separate tab in the workbook, auditors would want to see the detail behind those totals as illustrated on the slide. And the detail should tie within the total. As you can see on the last two slides, populating these audit templates can be very time-consuming, and this is kind of what the future cost reporting requirements are going to include, and so that's what we're going to get into later in this presentation. And now I will hand it back over to Amy for our next polling question.
All right, thank you, Heather. So our first polling question is up, and we will give you a few moments to respond. To respond, please click the button next to the answer you choose and hit submit. And if you cannot see the submit button, please just enlarge the slide area. So the question is, some hospitals use an estimate for S10 data for the initial filing and then use more resources to compile detail and revise the data prior to audit. Where do you use more resources? A, we spend more time and resources on the initial cost report filing. B, we spend more time and resources on the revised cost report filing. C, we spend about the same time and resources on the initial and revised cost report filings. Or D, not applicable, or I do not know. And we'll leave this up here for a few more seconds to give people time to respond. And you will need to respond on the actual slide. I see some people submitting via the Q&A window. Okay, Heather, here are the results.
Oh, wow. I think this is a pretty good mix as to what is being shown here. I'll just say that, you know, from my experience is these audits give you a very short time frame to turn around some of this data. So looking at this initial filing and these future template requirements, a good portion of you are spending time on that. So I think that's good to note. All right, so moving on to kind of the overview of what we're going to cover. Just like the 2018 audits, there were samples selected from both the charity and bad debt listings, as well as issues on providing the support and some of the findings as well. So here on this slide, diving into the detail of the samples, you can see that during the 2019 audits, there's a variance of how MACs are treating these sample sizes for charity. This chart shows the range of the number of categories on the total number of accounts that were sampled. Some MACs have set their criteria on uninsured and insured claims and further separated those into inpatient and outpatient accounts, or high and low stratas based on the individual charity write-offs amounts claimed on S10. And then on the opposite end of the spectrum, you can see that there are a few MACs that may only pull 5 to 8 sampled accounts. Something that I'd like to note was that during these 2019 audits, there were a few auditors that noted if there was no material impact or no threshold change between the current year and the prior year of the charity reported on lines 20, they were not pulling samples for charity. That means that they were very few hospitals that actually had to provide charity documentation and go through all of these as well. So moving on to the documentation that's requested for these samples, generally the same documentation is required for each sample patient, whether it's a UB or an itemized bill. They're requested to verify the patient charges and to verify professional fees are excluded from the claimed amounts. Patient account histories are extremely important and requested, so they're verifying that the charity write-off matches the patient's financial systems. Auditors are obviously requesting the charity care applications and approval forms, as well as any underlying support detailed in the policy necessary for a patient to qualify for charity. And for the insured charity patients, the MACs are also requesting remittance advices and EOBs to verify that only charity discounts related to patient responsibility amounts are included in column 2. One thing hospitals need to keep in mind is when migrating to a new system is to ensure that these data elements can still be retrieved. We have seen a number of hospitals really struggle with retrieving this documentation, especially in a timely manner when these auditors only allow a 2-week time frame to supply this documentation in return. So to jump forward on the notable audit findings from these samples, as I've mentioned previously, auditors are requesting all of the documentation be required per the policy to grant a patient charity care during this audit. So what that means is if your policy states that you must include W-2s, pay stubs, bank statements, basically any and all of those items spelled out in the policy, the auditors are looking for that type of documentation. If the policy stated that a patient must have 10 specific documentations to qualify for charity, the MACs are requiring all 10 of those items be supplied during the audit. And any lack of documentation led to adverse audit findings and its potential for large extrapolations as well. And for facilities that grant presumptive eligibility scoring models or use an outside vendor for presumptive eligibility, the MACs are requiring some type of score sheet or approval sheet proving that the patient qualified for charity. It's not just enough just to supply an account history showing, hey, my patient got a presumptive charity discount. We saw hospitals struggle to obtain this type of documentation with their outside vendor, especially with the 2-week time frame that these auditors give. And so some of that may have led to adverse audit determinations and included extrapolations. So moving on to additional sample findings as it relates to insured charity, after reviewing remittance advices and EOBs, the charity care write-offs were determined at times to include insurance denial charges, non-covered charges, or even limited benefit charges that could have been reported in the uninsured column. The S10 instructions state for insured patients, you should only be claiming co-insurance, deductible, and copay for column 2. For uninsured discounts, if it was found that while reviewing a UB or an itemized bill that not all of the total charges matched the write-off amounts for uninsured claims. And some additional issues that some hospitals experienced was that when they're combining charges for multiple accounts into one single account, we saw this come up, which made a review very difficult for hospitals to obtain the necessary documentation for each pre-emerged account to satisfy the audit request. So now that we've gone over a little bit about the sample sizes and what can be found during the testing of these accounts, let's go over the impacts to the UC payments that these findings create by how auditors handle them. Now, as I mentioned previously, no auditor, not even within the same MAC, has handled these audit findings the same from our experience. The most common practice of these audit findings relate to extrapolations. Extrapolations can be handled in what I've seen in 2 different ways. Depending on a number of categories the auditors select, they may choose to extrapolate across the specific category in which the error was found, or they may choose to extrapolate across the entire population. Now, there are some auditors that have found that if a population of sampling has been deemed to be found as insured or uninsured, the auditors can choose to reclass those between the 2 columns of charity, depending on what their findings are. An example of being reclassed would be where their insured accounts had remits or EOBs, which showed the charges written off to charity were related to non-covered charges rather than the co-insurance, deductible, and copay. And based on these findings, the auditors would then create an extrapolation percentage to reclass those amounts from the insured column 2 to the uninsured column 1, rather than just disallowing the errored sample. There were few auditors that will just disallow an individual errored account. Figliosi, a popular subcontractor that has handled a number of these audits, will primarily disallow the errored sample account rather than extrapolating, especially if this just seems to be a one-off finding rather than an issue potentially related, such as professional fees that could affect an entire population. Other than this specific contractor, what we've seen is just disallowing an individual sample account kind of comes at the discretion and the decision of the specific auditor handling those audits. So on this slide here, this is a great example showing the impact for a reclass of insured charity to uninsured charity. Now during this audit, it was found that a number of records were identified to have uninsured discounts and should have been reported as uninsured instead of insured. This led to the reason for moving these dollars between the two columns. And during this audit, these dollars that are being moved were actually identified by a patient-level detailed listing. And so these are true dollars and not the cause of an extrapolation. Now, as you can see, there's a large impact of $2.5 million that falls to line 30 after this reclass. And this is mainly because the insured charity, column 2, is not subject to the cost to charge ratio. Once these dollars are moved from column 2 to column 1 is subject to the cost to charge ratio, and that's what creates this large impact. So moving on to bad debt. Every MAC, again, pulled a sample of bad debt. Accounts from bad debt. And as you can see, similar to charity, the bad debt samples range from all different sizes per MACs. Within the templates provided by the MACs to populate the bad debt detail, it was requested to identify accounts included in bad debt listings as uninsured or insured. And some MACs may have even pulled their samples based on these individual categories as well. And similar to the documentation requested for charity, UBs, remits, and EOBs and account histories are also requested. And again, I'd like to note that similar to what happened with charity during these 2019 audits, there are a few auditors that noted if there was no material impact of change between the current year and prior year, they were also not pulling any accounts to sample for bad debt as well. Now, on this slide, I've listed some of the findings from the bad debt reviews, and I'll just briefly discuss a few of them. We've seen accounts not properly given a self-pay discount after insurance has recouped their payment. We've also seen reversals of bad debt write-offs that did not always use the correct associated bad debt transaction code, and therefore bad debt detail was overstated. Some hospitals were unable to supply remittance advices for legacy accounts from previous systems, and auditors were to remove these amounts for not having proper documentation and extrapolate those results. Consistent with the prior year audits, there are some instances where hospitals stated bad debt recoveries were included in the bad debt detailed listings, but when really the support that's being provided to the auditor, you can clearly see that the write-off amounts do not include recoveries. Hospitals should be capturing all of the activity reported on the bad debt general ledger, not just the gross write-offs from the active AR to bad debt. We see a number of facilities struggling to obtain the proper detail, and then these findings occur during the audits. There are at times when preparing the as-filed S10 where the recoveries may be included by adding a line item or summary total number to net down line 26. As these S10 audits continue, more and more auditors are wanting to be supplied the patient level detail of these recoveries. If they can't be, they're wanting to validate the removal of these by extrapolations. Just to touch on kind of the non-Medicare bad debt and Medicare bad debt, there are timing differences between the total bad debt and Medicare bad debt. For example, if there are traditional self-pay Medicare accounts where patient responsibility was written off to bad debt in 1 year, but it was claimed as Medicare bad debt in the future fiscal year, when the claim was returned from the collection agency and deemed uncollectible. Line 26 states to only include write-offs that occurred during the cost reporting period. We've seen a few auditors question why traditional Medicare bad debts aren't being added to line 26 when in reality they aren't written off during the cost reporting period. So here on this slide, I've shown a small bad debt sample where the auditor found errors mainly related to the recoveries not being included in the detailed listing. As I mentioned previously, it's important to ensure that you're obtaining the patient-level detail of those recoveries rather than just adding a line item total to net down, line 26. So this facility did net down line 26 for their as-filed cost report by adding a line item total recovery amount reported on their general ledger. However, during the audit, the auditor cannot verify that these recovery payments are truly being captured within the detail. So this led to a decrease in their line 26 by a total of 6.43%, which is a difference of $1.3 million. And so continuing from the last slide, here overall you can see that the financial impact of the 6.43% errored extrapolation can cause. Just like the uninsured charity column 1 from line 20, line 26 is also subject to the cost to charge ratio. The removal of $1.3 million of line 26 overall impacts this UC calculation by approximately $91,000. The biggest question in the hospitals is how do these audit adjustments impact my overall UC? You know, if you're not aware of how these audit adjustments are affecting your facility, reach out to our office. We also see at times these audit adjustments that are being made could potentially be made in error by auditors. And sometimes we get those reversed by just providing a simple phone call and explaining additional information that could save the hospital some of these large extrapolations and save them dollars for their UC. So kind of to wrap this up, I'm going to go over these deadlines quickly. So CMS wants to have these audits wrapped up by December 31st. So if your audit has not been wrapped up, be on the lookout that your auditor is going to be reaching out here in the next couple weeks. And consistent with the prior year's audits, there's still no consistency in what we can see as far as even within each MAC or each individual auditor. I'm going to go ahead and pass this over to Jonathan and see if he has some time to go over the HICRIS analysis.
All right, thank you, Heather. I think I'll skip through some of these slides so we can get through the proposed instructions. I think and certainly you can get a copy of these slides. I think the point of these next 3 or 4 slides are to show you the results of the 2018 audits. The 2019 audits won't be in HICRIS until obviously the beginning of the first quarter of next year. And so what we're seeing is still massive changes in the line 30 amounts, in the charity amounts, and we believe, and also I should say the bad debt amounts. And so what we're seeing in these 2019 audits is mirroring what we saw in the 2018. And so just when those 2019 audits results come out, we'll make sure to update those findings and give you the kind of the results of how that looks. But I think we're going to first start with our next polling question.
All right, thank you. So our second polling question, are you concerned about your federal fiscal year 2020 UC reporting given your experience in the 2019 S10 audits? A, we feel comfortable. B, somewhat concerned. C, very concerned. Or D, not applicable. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions that we pull up throughout the webcast. Leave this up for a few more seconds to make sure everyone gets their CPE. All right, here are the results.
All right, thanks, Amy. I think just like probably the previous question, we've got a good mix here, but close to 40% are either somewhat concerned or very concerned, and that's kind of what we've been seeing. As these audits continue, the auditors are getting more focused on the detail, asking more detailed questions, and that's ultimately sometimes causing more concerns about whether it's the policy, whether it's the procedures put in place to grant a patient charity, whether it's your bad debt. So that's something to look forward to, or maybe not forward to, but look to maybe revise those 2020 cost reports before they're audited early next year. So kind of with all that background of the UC payment and the latest audit cycles, we'll spend the rest of our time diving into DISH, S10, and Medicare Bad Debt Proposed Instructions. So in accordance with the Paper Reduction Act, CMS published a notice in the Federal Register dated November 10th, 2020, regarding a proposed revision to the Medicare cost report. So that comment period ended January 11th, 2011 on those proposed instructions. And most of the revisions would go into effect for cost reports beginning on or after 10/1/2020. So before we get into all the changes, I do want to make it clear that these instructions have not been finalized. Some suggest that CMS is likely to reissue the transmittal for further comment and postpone the release date, while others have suggested that this transmittal is ready to be finalized at any moment. So right now, we don't have any new information to share on that front, but we do want to make sure hospitals are aware of these new instructions, as some of them are a major departure on how you are currently compiling these listings, and will require some significant upfront time to comply with these instructions if they are finalized in their current form. So let's first look at the changes in Medicare DISH from the proposed instructions. For some background, currently cost report periods beginning on or after 10/1/2018, a patient detail listing that ties to the cost report amounts must be submitted with your cost report, or you risk cost report rejection. So right now, there is no template in what needs to be submitted, only the prerequisite that it ties to your cost report amount. So now, under these new proposed instructions, cost reports beginning on or after 10/1/20, there's a new template, Exhibit 3A, that must be completed for each category of days from S2. So that's the in-state and out-of-state paid days, the in-state and out-of-state unpaid days, and along with Medicaid HMO days and other Medicaid L&D days. So here's a copy of the new template that will need to be filled out for each category. Some notable items I've highlighted include the Medicaid ID, the eligibility codes, and Medicare status, and I'll touch on each of those as we go through this template. So let's quickly walk through some of the columns. So columns 1 through 4 ask for demographic information. Column 5 is that Medicaid ID number, which may not always be available just from your patient financial system. So you'll need to make sure you retrieve that from your Medicaid eligibility matches and include it in this template. So kind of skipping ahead to column 10, that's the state eligibility code. So in a lot of cases, this information is requested during an audit and sometimes only for a sample of accounts. So you can see now this will be required for every account that is claimed in the DISH calculation. So I guess one of the questions is kind of, have you reviewed your current DISH reports to determine if you are claiming any account just based on maybe Medicaid payment? It sure looks like they're expecting program code for all accounts with this new template. And another thing to keep in mind, that with all these program codes listed, are you ensuring that they will meet the requirements to be included in the DISH calc? There are program codes for each state for Medicaid individuals that don't meet the statutory requirements. So kind of moving forward, columns 11 and 12 are to report the number of eligible days, including L&D days. Another new item is 13 and 14. That's related to other insurance and other payer identification. And then lastly is the Medicare eligibility information. So if there are any accounts that you're including that have some Medicare Part A or Part B coverage, you'll need to include that information in those columns. And now kind of moving on to the S10 Proposed Changes. As we walk through the S10 audits and their findings, you can see why CMS is trying to clarify some of these instructions and to issue templates from kind of the beginning, from the filing of the cost report. These changes, like DISH, if finalized, will be in effect for cost reporting periods beginning on or after 10/1/2020. So the first item they clarified that only charges from a written financial assistance policy can be included in charity care. And I know we talked about this a little earlier in the audit section, the issues that can come up if they're not in the policy. They also clarified that CMS does not mandate the eligibility criteria, but the hospital policy sets the qualifications. There's been a lot of questions in the past on if there was going to be a nationwide kind of policy for charity, but CMS is making this clear that that's not the case. So I just posed the question on the slide for hospital staff. Do you know if your current policy covers all the scenarios that occur at your hospital that could potentially be included as charity? Kind of things such as non-covered Medicaid services or other charges that are currently being written off as either an administrative adjustment or other similar adjustments mapped as a contractual. And the last bullet point of insured charity versus bad debt is just a question regarding how uncompensated care dollars are captured on S10. Insured charity is not subject to the hospital's cost to charge ratio, while bad debt is subject to the CCR. So for your typical hospitals, that insured charity write-off is worth 4 to 5 times more in a future UC calculation. It's something that should be accounted for when reviewing your current policy and your current success rate on your bad debt recoveries. CMS also added a definition of courtesy allowances to S10, and there's nothing really new to report on that definition. If you had previously seen CMS's S10 Q&A they released several years back, physician and clergy discounts are not allowed, plus prompt pay, friends and family, and other employee fringe benefits are also not allowed. So CMS also added the term medically necessary health services to the definition of allowable charity. And so that will impact some hospitals on who they can claim. CMS then added a note that the provider should exclude all charges associated with patients who received a HRSA Administrative Provider Relief Fund payment. With those familiar with the current S10 audits, all MACs are currently asking the same question and making sure that no dollars are claimed where the hospital received any HRSA payment for their charges. This includes not only charity, but also bad debt. But something that's not addressed is what happens to accounts that are rejected for a HRSA payment. Can you claim those on S10? Are hospitals currently excluding those amounts right now? I think many providers are not pursuing collection on those accounts, so can that write-off be claimed on S10? Are these discounts even included in a charity policy? There can be significant dollars right now that are being written off but not captured on S10, depending on how your hospital is handling these situations. One of the most significant changes to S10 is how the cost to charge ratio will be calculated. The CCR will now be calculated using only the acute portion of the hospital. And all of the exempt and provider-based clinic charges are excluded from that ratio. And for some hospitals, this will impact your CCR significantly compared to prior year reports. I've copied the exact language from the proposed instructions that excludes all of the non-acute units from the calculation. So continuing on with the S10 reporting changes, let's start with a clarification on line 20. CMS adds co-payments into the discounts that should be included in the insured column 2. Now, so for a long time, there's been some debate regarding co-payments as they were not explicitly included in previous versions of the instructions. Well, now kind of that debate can finally end. And much like the CCR change for cost reports beginning on or after 10/1/20, only short-term hospital, inpatient, and outpatient services billable under the hospital CCN can be included as charity. All of your SNF, rehab, exempt psych, all of your non-short-term acute charges are excluded from S10. This will add another layer of complexity to reporting your S10, as now after identifying your charity, you now have to separate and exclude certain charges. And as we've seen with the data we've reviewed, patients may and will have charges from different areas of the hospital rolled up into one account. So it may not be as easy as kind of just reviewing their discharge location and making your decision based solely on that information. Also, CMS has added a section to the new S10 to the new instructions regarding inferred contractual relationships. An inferred contractual relationship exists when a provider accepts an amount from an insurer as payment or partial payment on behalf of an insured patient. So that slightly changes previous instructions regarding contracted and non-contracted payers and how to handle those different situations. And then finally, kind of for line 22, starting with 10/1/20, that same logic would apply, that you would now only be including payments from the acute portion of the hospital. Now there's also a new line of the cost report moving forward, and that is line 25.01. It states that you are to enter the charges that represent the insured patient's liability for medically necessary hospitals, or medically necessary hospital services, I should say, other than deductible, co-insurance, and copay amounts. These charges are subject to the CCR, and they must also be reported on line 20, column 2. And for reference, I put on the slide the line 20, column 2 instructions that state the exact same thing. So continuing from the previous slide, that line 25.01 is referring to non-covered, non-Medicaid charges written off to charity. I think the first question to ask yourself is, where are these charges currently being claimed on your S10 right now? Does your hospital actually claim any of these non-covered amounts? What this new 25.01 field does is that it separates these types of charges even more going forward. So it's crucial you understand what your discount is covering so that you can properly report where to record the amount on Worksheet S-10. So just like for Medicare DISH, CMS is proposing a new template for all patient details submitted with any cost report filing. There will be separate listings for uninsured and insured patients. And you can see it starts with the patient's names and dates of service along with their patient account number. So I'm jumping to column 6, the UI, INC field is asking the provider to indicate if the patient was uninsured or insured but not covered. Kind of moving ahead, column 7, you enter the name of the insurer, but kind of what do you do if they have secondary or tertiary payers? Column 8 and 9 is the patient's MBI and Medicaid ID. You know, a lot of the times, or most of the times on these patients, you may not have that information. For column 10, the approved, CMS is asking you to enter yes if the patient was written off to charity care pursuant to the hospital's written charity care or financial assistance policy. Otherwise, you enter no. So I'm trying to think of a scenario where you would need to enter no and have it included on the list, because as we've seen before, and it's reiterated in the new instructions, all discounts included in charity must be written off in accordance with written policies. So for column 11, you're to identify the policy under which the charity care was approved. The instructions state to enter charity if the patient was approved for charity care under the hospital written charity care policy, and to enter FAP if the patient was approved for charity care under the hospital's written FAP. I think our experience is those terms are used interchangeably by hospitals. So it's hard to see what CMS is driving with that comment. We do see hospitals have multiple policies that cover different discounts, and I believe if you have that situation, that is what the template is asking for you to differentiate. So while the first 11 columns could be a little confusing in certain situations, it actually gets a lot trickier with some of the remaining columns. Skipping ahead to column 14, non-covered charges has a different criteria on whether you are looking at uninsured or insured accounts. And then you head into the reduction section of the new template that includes pro-fee charges, non-covered charges, uninsured discounts, contractual allowances, and courtesy discounts. And then column 20, gross charges, net of reductions is a result of columns 12 minus columns 15 through 19. And then you get to column 21, allowed charity charges. That's the portion of charges from column 20 that you are claiming. So CMS in column 22 is making you calculate the percentage of charity care charges in relation to the gross charges net of reductions from column 20. So how or what they're going to use this column for is kind of unclear from the instructions, but you certainly are having to provide that ratio. Column 3 is just a copy of column 17, the uninsured discounts. And then the remaining columns are kind of calculated amounts. I'll skip to column 25. That's the write-off date. That should be within the cost reporting period. And then finally, I'll skip to column 27. Those are the payments received for patients that were previously written off to line 20. So that's more of your line 22 reported amounts. So as you can see, there's just a ton of information on this template, ton of different situations, ton of different ways to use each column because it can be used differently if it's an uninsured or insured patient. And kind of, I guess my opinion is I think this is quite a bit more difficult than the auditor's template that they're currently using for the last 2 years during an audit. So kind of taking a step back, you can clearly see that completing this template correctly is going to take some significant time. And the current requirement of just providing a detailed listing that ties to line 20 is going to change drastically if this template is implemented. Now I think that leads us to our third polling question.
All right, thank you. So our third question, do you think you can produce complete and accurate data under the Paperwork Reduction Act requirement? A, yes, we should be able to. B, no, we have some work to do. C, not sure, or D, not applicable. And I do want to thank the audience for submitting your questions for the presenters. We do have quite a bit of content that we're covering today, so that if we don't have time to respond to yours during the webcast, we will do our best to follow up with you afterwards. And it looks like most have had a chance to respond. So here are the results.
All right, I think it looks like the majority of you kind of feel pretty good about the current reporting processes and will be able to meet the requirements as outlined so far. But I should say the requirements don't end with DISH and charity. So there's also a new bad debt reporting requirement you'll want to be prepared for, and I think we'll cover it right now. So just like charity, there's also a bad debt template being proposed, and I guess the good news is that it's more closely resembles the current bad debt audit template. However, the thing to remember is that populating this template will be required at the time of the cost report filing, where right now bad debt detail is not required. So on the next slide, we'll go over the template. You can see it starts with demographic information and then lists out total charges and all the activity. Columns 5 and 6 are the dates of service of the patient, but you got to make sure you are pulling the bad debt based on write-off date. So as I mentioned before, this template is very close kind of to the current audit template, but it does add one new field, and that is secondary payer. Kind of moving forward, you see column 9 is the service indicator. That's inpatient and outpatient. We see that used frequently to pull samples. Another note is column 17, and that calculates the net patient bad debt amount by computing the ratio of hospital charges to hospital charges plus professional charges from column 11. So if you have professional fees commingled with hospital charges, there's a place on this template to calculate that amount. And then I guess the final note about this detail is we just want you to strongly encourage, or I guess we want to strongly encourage hospitals to begin preparing this detail early in the cost report prep cycle. So bad debts can be a real challenge depending on your patient financial system and how the system identifies when the patients are written off active AR and placed in bad debt. So a bad debt reconciliation of the direct write-offs, including reversals, adjustments, and recoveries, is a must to have any confidence that the patient detail you're reporting ties back to your financials. There's also a new template for Medicare Bad Debt that we also wanted to briefly cover. The new Exhibit 2A will replace the current exhibit. The format is similar to the current Exhibit 2. There are several new required columns that providers need to be aware of. There's remittance advice date. There's now 2 columns for that, a Medicare and Medicaid. There's also new required dates, and descriptions are clear, such as kind of AR write-off date, collection agency return date, some other additional columns. And I think the point is this, that it may take a little bit more time and effort to prepare this template, but I think the hope is that these new fields will allow the audits to go smoother. And I think that leads us to possibly our last polling question.
Yes, so our last polling question is, assuming the new reporting requirements are finalized, will you consider enlisting outside assistance to help? A, yes, we need help. B, no, we can handle this in-house. C, no need, we already have a vendor to help with this. Or D, not applicable. And while you're responding, for those that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We'll also be sending them via email tomorrow along with the recording of this webcast. All right, here are the results.
All right. I think almost a majority of you are needing some help. Some already have it, as you can see, but some still need help, and we're certainly here to help you through that. You know, there's a lot of information with these new instructions and these new templates. It's required a massive amount of upfront work that's needed for the filing. So it's certainly just something to get prepared right now before they implement it. And so I guess as we wrap up our presentation, we wanted to leave you with a few additional resources. You can subscribe to the healthcare industry updates using the link on this slide. Additionally, we want to highlight our firm's dedicated web pages regarding COVID-19, along with links to our upcoming events. And it kind of, with that, it looks like we're running up against the full hour, so we'll not be able to take any questions on the call. We'll certainly be getting back with each of you who have asked questions, and also try to get out a Q&A for items that apply to the audience at large. And so kind of with that, we want to thank you for all your time today. Please don't hesitate to reach out if we could be of any assistance to you. I think I'll toss it back to Amy to wrap things up.
All right, thank you. And thank you, Jonathan and Heather, for a great presentation today. And to our audience, if you met all CPE requirements, your certificate is available to download now in the CPE progress window. I will keep the console open for a few minutes to give you time to download, and then a copy will be emailed within 3 weeks should you have any difficulty downloading it now. And also a reminder that if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in your console. Finally, here is a link to an online survey for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining our webcast. We hope you'll join us again next time.